How to generate a regular income of $250 per month, top 5 cash-generating assets for a global audience. Generating a steady monthly income of $250, approximately $3,000 annually, is a universal financial goal for people worldwide. The key is to invest in assets that produce consistent cash flow. In this article, we explore 5 such assets, explain how they generate income, and highlight their associated risks. Whether you're a beginner or an experienced investor from any part of the world, these options can help you build a reliable income stream. Note, $250 per month is roughly equivalent to Rs. 20,000 for Indian readers, but this guide is tailored for a global audience. Dividend-paying stocks. How they generate cash. Dividend-paying stocks are shares of companies that distribute a portion of their profits to shareholders, typically quarterly or annually. By building a diversified portfolio of such stocks, you can create a steady cash flow. For example, a portfolio might yield $1,750 annually, as seen in a real-life case. Renowned investor Warren Buffett is projected to earn over $3 billion in dividends in 2025, demonstrating the potential of a well-constructed dividend portfolio. How to start. Research companies with a strong history of consistent dividends, such as those in the S&P 500 Dividend Aristocrats for U.S. investors, or global blue-chip firms like Unilever or Nestle. Aim for stocks with a dividend yield of 3 to 5%, and invest when prices are reasonable to reduce risk. Use platforms like Robinhood, E-Trade, or Interactive Brokers, and consult educational resources to select stocks. Risks. The primary risk is capital loss due to market fluctuations. For example, a $100 investment could drop to $50, though the loss is only realized if you sell. Dividends are not guaranteed and may be cut if the company faces financial challenges. Mitigate risks by diversifying across sectors, for example, utilities, consumer goods, and avoiding stocks at all-time highs. 2. Corporate bonds. How they generate cash. Corporate bonds are debt instruments issued by companies to raise capital. Investors receive regular interest payments, often monthly or semi-annually, until the bond matures. For example, a $1,000 investment in a bond with a 5% yield could provide $4.17 monthly, $50 annually. In some markets, minimum investments have been lowered, making bonds more accessible globally. How to start. Explore bond platforms like Fidelity, Charles Schwab, or international brokers offering corporate bonds. Look for bonds with varying tenures, for example, 1-5 years, and payment schedules to match your needs. Learn key terms like yield to maturity, YTM, and coupon rate to make informed decisions. Risks. Bonds carry default risk, where the issuer fails to pay interest or principal. Higher yield bonds often come with higher risk. Opt for investment-grade bonds, rated BBB or higher by agencies like S&P or Moody's, from reputable companies to reduce risk. Diversify across issuers and industries. 3. Dividend-focused mutual funds or ETFs. How they generate cash. Dividend-focused mutual funds or exchange-traded funds, ETFs, pool money to invest in a diversified portfolio of dividend-paying stocks or bonds, distributing profits to investors periodically, monthly, quarterly, or annually. For example, a fund like the Vanguard Dividend Appreciation ETF, VIG, may yield 2 to 3% annually, providing regular payouts. How to start. Choose funds with a strong track record of consistent distributions, such as the iShares Select Dividend ETF, DVY, or global funds like the Spider S&P Global Dividend ETF, WDIV. Platforms like Vanguard, Fidelity, or local brokers in your country can facilitate investments. Check the fund's historical yield and portfolio composition, for example, equity versus debt. Risks. Returns depend on market performance, and dividends are not guaranteed. Equity-heavy funds are volatile, while bond-heavy funds may offer lower but more stable returns. Review the fund's expense ratio and past performance and diversify across fund types to manage risk. 4. Commercial real estate. How they generate cash. Commercial real estate, such as office buildings, warehouses, or retail spaces, generates rental income with yields typically ranging from 5 to 8% globally. Demand for warehousing, driven by e-commerce, and office spaces for corporate hubs, has made this asset attractive for high-net-worth investors. How to start. Direct investment requires significant capital, often $100,000 or more, depending on the market. Alternatively, explore real estate crowdfunding platforms like Fundrise, US, Crowd Property, UK, or local equivalents, which allow smaller investments. Research properties in high-demand areas with stable tenants. Risks: high capital requirements limit accessibility for retail investors. Rental income depends on market conditions, tenant reliability, and property maintenance costs. Economic downturns can lead to vacancies. Conduct thorough due diligence on property location and market trends. 5. Real estate investment trusts, REITs. How they generate cash. REITs are companies that own or finance income-producing real estate and distribute most of their profits as dividends, often quarterly. For example, a REIT like Realty Income Corporation pays monthly dividends, offering a yield of around 5 to 6%. A $1,000 investment could generate $50.60 annually. How to start? Invest in publicly traded REITs through stock exchanges using brokers like TD Ameritrade or eToro. Research REITs with strong portfolios, such as those in retail, healthcare, or logistics. For example, Prologis PLD focuses on warehouses, benefiting from e-commerce growth. Compare yields and historical performance. Risks: REIT values fluctuate with market conditions, and dividend yields depend on the purchase price. Economic downturns or rising interest rates can impact REIT performance. Diversify across REIT sectors, for example, residential, commercial, and check the REIT's management quality. Key considerations for safe investing. Understand your risk tolerance. Stocks and dividend funds are volatile, while bonds and REITs offer more stability but carry default or market risks. Commercial real estate is capital-intensive and less liquid. Research thoroughly. Only invest in assets you understand. Use financial platforms, educational videos, or advisors to deepen your knowledge. Diversify globally. Spread investments across asset classes, sectors, and geographies to reduce risk. For example, combine US REITs with European dividend stocks. Start small. Test assets like bonds or REITs with low minimum investments to gain experience. Tax implications. Dividend and interest income may be taxable, varying by country. Consult a tax advisor to understand local regulations. How much to invest for $250 monthly income? To generate $250 per month, $3,000 annually, estimate the required investment based on the asset's yield. Dividend stocks, 4% yield, $75,000, $3,000, 0.04. Corporate bonds, 5% yield, $60,000, $3,000, 0.05. Dividend ETFs, 3% yield, $100,000, $3,000, 0.03. Commercial real estate, 6% yield, $50,000, $3,000, 0.06. REITs, 5% yield, $60,000, $3,000, 0.05. These are approximate figures, and actual returns vary based on market conditions, taxes, and fees. Currency fluctuations may also affect non-US investors. Generating a regular income of $250 per month is achievable through dividend-paying stocks, corporate bonds, dividend-focused mutual funds, ETFs, commercial real estate, or REITs. Each asset suits different risk profiles and capital levels, so choose based on your financial goals and resources. Platforms like Fidelity, https://www.fidelity.com/, Vanguard, https://www.vanguard.com/, or Fundrise, https://www.fundrise.com/ can help you start. Always conduct thorough research, diversify investments, and consult a financial advisor if needed. Safe investing starts with understanding the asset and aligning it with your goals. Disclaimer: investments in debt securities, municipal debt securities, and securitized debt instruments carry risks, including delays or defaults in payment. Always review offer-related documents carefully before investing.